Hey, everybody, welcome back to the show. I'm super excited to have Andy Quill with us today. He is the managing director of Alta Peterman Global, as well as an adjunct professor of investments at his alma mater, Hamlin University. Anthony, welcome to the show. Super excited to have you.
Thanks for having me. This is gonna be fun.
No, for sure. So I usually start out origin story, almost like comic book episode one, just like who is Anthony Quill and how did you come to be doing the work that you're doing right now?
Yeah. So this might take a little bit of time, but I think the
Sure.
how it weaves together is important. And you mentioned that adjunct professorship at Hamlin, and one of the things I've done a lot of there is bringing in um, other people from the community, similar to what you're doing, to show their help, have them talk about their origin story. And one of the things I've learned is that these stories are never linear.
Hmm.
No one ever sits at 21 and is like, I want to do this, and then you become whatever that dream is. And my story is one of kind of a blind man poking around and just ending up where I'm at. And so, kind of starting where I'm at, as a managing director at Alta Team Global, I advise entrepreneurial families on everything associated with their financial world. And so that is narrowly speaking their investment portfolios, and broadly, if it's financial, we help those families. But I, had no dream of ever coming here and had no idea that this world even existed as a kid. I grew up in what I call a very normal suburban family. My dad was an electrician. My mom ran daycare during the day, worked at UPS during the nights, very working class, um, and had a pretty comfortable life until my dad filed bankruptcy in must have been around 2000. And so
Okay.
that for me kind of kicked off the next few decisions I made in my life, because the one thing I did not want is to have financial instability.
Hmm.
And so I didn't really care what I did. I just wanted to not have that. Uh,
Yes.
and so I was planning on just going into the trades like my dad. No one in my family had ever gone to college. And that includes extended family. And my parents said, absolutely not. Like, that's how we got into this mess. That world is very, subject to the real economy, and you have no control over it. So they said, you have to go to college. And I said, okay. So I went into the counselor's office, and I remember very clearly there was this like circle table sitting there with some pamphlets. And I was waiting my turn, and the pamphlets were for Hamlin University. And so I was flipping through one. She came out, and I said, is Hamlin a good school? And she said, yeah, it's a great school. I said, thank you. I walked out the door, filled out an application, and went to Hamlin. Didn't look anywhere else, had no idea what the college search process was even like. Then I went there thinking I'd study pre-law, because in my mind, lawyers made a lot of money, they had stable lives. That seemed like a way to solve kind of that insecurity that I had felt. Uh,
Sure.
and I took a pre-law class and realized that A, it was really boring for me,
Uh-huh.
and B, I would have to memorize a lot of stuff, and my brain just does not function that way. So I stumbled into economics, and largely just because I liked it and it was fun,
Uh-huh.
and had no idea what I was going to do with that degree. And so coming out of college, I was lucky. That was 2007, so the world had not blown up yet.
Right.
I had two offers in finance leadership development programs. I had never taken a finance class. I don't think I knew what finance was really.
Hmm.
Um, they both paid the exact same amount. One was at Ameriprise Financial, one was at Ecolab. So
Okay.
financial services or manufacturing. Ameriprise paid $1,500 as a signing bonus. And so I ended up in financial services over $1,500 to pay down my student loans.
Wow.
And I mean, I think that's interesting when I teach this class. I like to tell it because I think sometimes students in their mind think that they have to plan out their next steps. And
Hmm.
mine's maybe a little on the extreme end, but I think most people have just, they end up where they're at because they followed opportunities as they came, and
Right.
you never know what's going to come your way. And so I, started in finance, quickly shifted into more investment management. And I had a mentor at the time at Ameriprise that was like, do you like what you're doing? I'm like, it's okay. And he's like, well, you've got another year of doing it before you specialize, and it's hard for you to get out of this world. So if you're going to leave, you got to do it now. And I was like, oh, that's great. It's 2009. Like, like, what am I going to do? And so he encouraged me, and I ended up at the University of Minnesota working with a man named Stuart Mason, who's a longtime friend now and probably the most important career mentor in my life,
Wow.
doing investment manager research. And so that opened my world up to this kind of institutional investment world, which is where I still stand today. I had planned on being at the U for a very long time. I did my master's degree while I was there, and we were doing some research work on developing economies. So I think frontier and emerging markets, these are economies that are less developed, far more uncertain outcomes, but do have stock markets. You can buy stock in them. We had a manager we were going to hire. I called that manager and said, hey, we're going to invest with you. And they said, about that, we have a different plan. We'd like to hire you instead. And so my wife was 7 months pregnant. We were living here in Minnesota. This manager was based in Malta in the EU. We hopped on a flight that weekend, checked out Malta, ended up moving when my firstborn was 2 months old. My daughter was born there. We spent first 5 years of his life living in Europe.
That's incredible.
Just an amazing experience. Had really nothing to do with my career up to that point. But while I was there, I ran a small hedge fund. So I learned a lot about individual stock research, how to build a portfolio of stocks, and kind of saw how the sausage was made from inside the butcher shop. And we hit the 5-year mark and decided it was time to come home. The guilt of having grandkids away from grandma and grandpa it built over time and finally cracked. Then we came back, and I didn't really know what that next step would be. I work at Alta now, but up until a year ago, we were a smaller firm called Envoy, started by 3 principals, one of whom was Brenda Selstrom that I knew well.
Okay.
And she called me one day and said, Anthony, I've got an opening on my team. You've never done it before. Come give it a shot. And then the rest is history. And so I started here a little over 6 years ago, with no direct experience in ultra high net worth wealth management. But Brenda believed in me, gave me a shot, and my winding road through my career ended up here. And to be honest, it's been the best career move I've made. And I think we'll get into a lot of this over time, but up until this point, it was very quantitative. It was very investment focused, very numbers driven. And now I deal with a lot of human beings.
Yes.
And the puzzles that I put together, the problems I help solve are far more complex because there are more emotions involved. There are more intrafamily dynamics. There's all sorts of things involved that did not exist in my prior life. And I've learned that I really enjoy those puzzles, and I enjoy the feeling that I get after helping to solve them, and helping families move along in their journey.
That's incredible. How about kind of along those lines, maybe share a little about your own journey working with founders and family businesses, and what kind of drew to that, and just maybe what lessons you've learned that have shaped your approach over the years dealing with people.
So I'm pretty fortunate in that our business is almost entirely focused on entrepreneurial families.
Okay.
So you can think of this ultra high net worth space. You have a lot of what I would call old money. So money that has been inherited over the years. And you can imagine those personalities often, but not always, are different. They weren't in the trenches.
Yes.
The entrepreneur world is quite a bit different. There's a lot of sacrifice that goes on in these families, and it's very fresh. And so coming into this, I came into it with what I think is probably the mindset that most prospective clients come into it, that most of the industry thinks about it, and came into it like, I have an investment problem here that I need to solve. Build the best portfolio of the best investments with the highest return, and that's my job. And I learned very quickly that is very important. It is kind of the cornerstone of this whole program, but it's not the only thing. And so I think what I've learned to do better is to listen more. So not try to solve problems right away, but give problems time to unfold. Because I think sometimes the families themselves haven't slowed down, especially if they're recent to that entrepreneurial journey, which is moving at light speed.
Right.
I don't think they've slowed down often to think through, like, what are they trying to solve? Like, what is the purpose of their wealth? Why do they have this? And what do they want it to do for them? So for me, and personally, that's been a really fun journey. I still get to do all the investment stuff that I know and love, but I get to do it within a more meaningful context, which is helping these families sometimes figure out, answer that primary question, like, why do we have this wealth? How do we
Yeah.
make sure that wealth is an asset and not a liability that doesn't break our family apart, but it's a bond that pulls us closer together.
Sure.
Um, and with that, it's helped me think, far more long term, because this is for the families I work with, this is multi-generational wealth. So it's not just mom or dad's money, it's, kids, grandkids, and, into the future. A lot of it's going to charity. So you have other stakeholders that are also important. And it's kind of re-emphasized this idea that strategy trumps tactics any day. And so
Okay.
if you do not have the right strategy, you can pick the best investments you want, but if you're solving the wrong problem, you're still going to get to the wrong answer.
Mm-hmm.
And so you really have to weigh your conversations and your thought to those bigger picture questions, so that when you start to use the tools at your disposal, you're answering the right question. If you're asking the wrong question, you're going to get to the wrong spot.
Right. What would you say? What would you say is the biggest mistake ultra high net worth families make when they're trying to build a lasting legacy?
I mean, there are some clear patterns, behavior. I think one is when you're an entrepreneur, your sense of kind of self-worth and how you get to success is through action. It's
Mm-hmm.
through constant decision making. When you transition from that world into my world, it's the exact opposite. The more decisions you make as an investor, the lower your returns are likely to be. And that, especially for the entrepreneur, and that does not matter whether it's man, woman, they want to act. And when especially if they sold their company, when their company's gone and they don't really have that much to do relative to where they were,
Yes.
they want to act. They want to pull the trigger. They want to trade. They want to change investments. And not only do you just end up in a worse place and you don't have as good of relationships with the investment managers that you're working with, but your taxes go up. And as a wealthy individual or wealthy family, you can't spend your pre-tax returns. You have to spend the after-tax returns. The government gets their chunk. And if they get a bigger chunk, that means you have less, even if you think you have a higher return. And so I think with entrepreneurial families, that can be really challenging. And that kind of goes hand in hand with, if you're an entrepreneur, you like the feeling of control.
Mm.
You can't
Yes.
be an entrepreneur and not be some sort of a control freak.
Right.
To some degree, it just doesn't work. And moving over, like, you have to learn to trust brand new people, and relatively quickly, and to let go of that control so you can step up to what we would say like the CEO or chairperson of, the business of your family, and let the people that you've hired to do their jobs do them well.
Mm. I can
That
see that.
that's a big transition.
Yeah. Because you're used to being, the master of your own destiny, the master of your own universe. Like, you are creating your reality.
That's exactly it.
And
You have
then it's
at least a
hard to let go of
perception of
that.
control. Yeah.
Right. Like, I decide how the world is and I
Yeah.
make it happen.
That's exactly. And in this world where you are largely a passive investor,
Yeah.
that surfing analogy is a better one. Like, you can buy the best board, do all this training, but you can't do anything till the wave comes.
Mm.
Nothing for you to do until the market offers you something to do. And I mean, you've seen it probably infinitely more than I have in your work. Like, that is hard for an entrepreneur to stomach.
Yes.
That is a hard psychological transition. And the truth is, everyone ends up somewhere on the continuum, but never makes it all the way over to, like, fully letting go. But they get there, and that comes through trust and time.
Yeah. How about, when a family decides to sell their business, what are some of the broader goals they should think about beyond just maximizing the sale price?
Yeah, I mean, so if you think about it first, just in pure financial terms, again, you can't spend the money that goes to the government. And so if
Right.
you focus too much on that sale price, which happens a lot, people anchor to a number, and they have a hard time adjusting away from it. You could have a very nice number and realize that what you get to take home is much, much less. And so I think getting founders to take a step back and break that anchor and start thinking about net. What do I want to receive? And that's not just net of income taxes. When you sell a business, you're going to have some sort of income taxes on the proceeds. But if you think 10, 20, 50 years down the line, you're also going to have estate taxes.
Mm.
And they can eat up as much of those gains as the income taxes can. And so you think about that 3 steps, a lot of founders barely get into the income tax side. Some get in there and have the right team and they have really great plans, but they maybe haven't started thinking about estate planning and end up paying a lot of estate taxes. And the ones that are really successful, that build the most true like family level net worth, are the ones that build out their advisory team as an entrepreneur when you probably feel, cash strapped and poor that entire time. And you end up giving away your wealth before you actually have it, which is hard. And it's very few founders that can get themselves to that stage when maybe they're very wealthy on paper, but they've been cash poor for 30 years and, really just want, like, they've got pent up demand. They have a bunch of stuff they want to buy and do. And the day that company's gone, they're going to do it all.
Yeah.
And then you got guys like me saying, well, why don't you give it to your kids? And they're like, wait, my kid's 10. Why would and it, brings up an interesting set of choices that can sometimes be uncomfortable. But like, if you have a lot of money and you assume that you can't consume it all, like you can't just spend it on your lifestyle and houses and boats and all this stuff, you only have 3 options with that money. You can give it to other individuals, which for most people is a family.
Mm-hmm.
You can give it to charity, or you can give it to the government in the form of taxes. But there is no magic bullet when you become ultra wealthy that gives you a 4th option.
Yes.
And so you kind of do have to start planning early if you don't want it to go to the government. And most entrepreneurs don't like to pay taxes.
Right.
And of the 3 buckets, that's the last one that they want to
exactly. Yeah. How about we touched on this a little bit, but just to the psychological, emotional toll a selling of a business can have on founders, especially when they're used to being the boss, being the founder, being the leader, driving everything.
Yeah, I
so
think
long.
It can be a big shift. You think about entrepreneurs, they're very busy. What we talked about earlier, they have a feeling of control over their destiny. They've sacrificed a lot. And you have limited time. And so if you're going to spend it on the business, that means you aren't spending it on hobbies. You're not spending it with your family. You're not spending it with your friends largely. And so when that turns off, when you go from having every hour of your day focused on, this company, your baby, to all of a sudden that thing being owned by someone else and you're just at home, that can be a huge undertaking. And you can have depression and anxiety issues in very rough cases. I think founders have time then to think, and you start to think about the sacrifices and you start to question, were they worth it? You might look at your kids that are now going into college and be like, man, I really didn't go to much of their stuff. I couldn't. I had this other use of your time, or like your parents may have passed away in that journey. You may have start to have some regrets on how you spend that time. And so I think it can be a big process for the entrepreneur to work through that and to realize that that is perfectly normal and is probably going to happen. Like you're going to have some version of that. And think like you all go from working to not, your friends are probably still working, or at least a lot of them. So when you're sitting at home all day, no one can go golf with you. So you got to make new friends. They're probably richer than you. Then you're going from feeling like the big dog to maybe a little bit inadequate again. And I think it can be really challenging for founders. And I think the expectation from people around them and from society as a whole is like, dude, you're really wealthy. Like, suck it up. Like, we're all struggling here. We all got stuff going on. You got more money than God. Like, quit whining about and figure it out. And I can empathize with that, maybe not sympathize with it, but it still doesn't take away the fact that that is a hard transition.
Yeah. I mean, yeah. What about, there's constant shifts in the economic climate, macro, micro. What are some key principles or strategies that you recommend for founders and for family offices looking to invest wisely, balancing growth and risk once we've come to
Yeah.
that point?
I mean, I think, back to what we were talking about early on, like the first step is you really got to determine what are you trying to achieve? Okay. The likelihood of your main goal being just to be richer, if you really reflect on it, is really low.
Mm-hmm.
A few people are just collecting money just to collect it, because in the end, it has to go somewhere. Some, if your spend is higher than your capital base, like that, yeah, that makes perfect sense because you need more money to support your lifestyle. Most of my clients, they have excess capital, from that standpoint. And so that first step is really trying to figure out for a family, like, what do you want, Johnson Family 2.0 to look like? What do you guys want to do? If you're an entrepreneur, do you want to sit on boards? Do you want to occupy your time that way?
Mm-hmm.
Say you were a med device guy, do you want to be active in that community? Because then you probably should reserve some assets for that because you're going to want to invest in companies and be active, but more, less as an operator and more as an angel investor.
Mm-hmm.
And so what we really try to do is upfront figure out what are your goals, translate those goals into financial terms, so into a dollar amount, and start reserving assets to support your lifestyle. So if you're going to spend $1 million a year, I can't put that in the stock market because what happens if the stock market has, a bad year? It's going to have it,
Mm-hmm.
and then we have to sell everything at the bottom. Like that's not good for long-term wealth accumulation. And so we'll set some money aside in very low risk investments. We'll take a portion and set it into kind of medium risk investments to get you through an economic cycle. So if the market's bad and you still want to spend your $1 million a year, well, we have somewhere we can pull it from that's not selling stock at the bottom. And then once we've kind of allocated, we've immunized those liabilities, then we get to have fun. And so we are building portfolios that would look very similar to what a high quality endowment or foundation would build. So these
Okay.
institutional quality portfolios, where our clients are invested in traditional asset classes. So just think individual publicly traded stocks and bonds, to hedge funds managed by some of the best hedge fund managers in the world, to private equity, distressed debt, venture capital, through very high quality institutional quality funds. And so we, once we set aside the easy money, we build a very diversified portfolio. We are uber focused on fees, because the more you pay for a service, an investment service, the less you have at the end.
Yes.
And at Alti, we're fortunate that, with our business model, that we don't sell product. And so we charge a family a fee that's very transparent. And then as we work with investment managers or service providers to bring down those fees, they pass directly through to the client. So a lot of our clients, instead of being through a feeder fund or a complex structure, they get to invest directly with, these high quality managers right alongside the University of Minnesota or the State of Minnesota Board of Investments. And they get access to things that they just could not have on their own. And then we think very long term. So we're not trading every day. We're not changing things. Kip, if you were a client, you wouldn't hear from me quarterly saying, "Hey, I got this great new idea. We're gonna, sell these stocks and buy these over here." We're building, a ship that can sail for your entire life.
Uh-huh.
And that's a big difference. But I think as clients become comfortable with that way of thinking, it frees them up to really think at that chairperson level and to not worry so much about what's going on at the individual investment level, because they know they're well diversified. They know they have only high quality managers. They know there's a lot of thought going into it. And they know that, for me as an advisor, I have no incentive to put you into fund A or fund B,
Right.
outside of, do I think it's good for you? Because my bonus is completely untied to the individual strategies I choose.
Yeah. How about, what do the smartest family offices know about culture and wealth that most investors miss?
Yeah, and I think, you know, in the family office space, you have a split between multifamily and single family.
Mm-hmm.
And they can be very different, and sometimes those lines blur. And we put out a report with Camden Wealth on kind of family office operational excellence, which is a great read. And for anyone that's in this space, it's a good way to understand what families are doing and how they're thinking about it. Um, at a multifamily office, we have the benefit of being able to build a broad, dynamic culture focused entirely on outcomes of the family.
Hmm.
Because we all have great career paths. You think someone very young in our organization, they could be here for a while, they could be in London for a while, they could be on the investment team for a while. And so what we try to do is create this culture of like open-mindedness, um, creative thought, and 100% focused on the client and their outcomes. The single family office world is more difficult
Yes.
um, because you have one family. And so the culture of that office is tied to that family. And by family, I usually mean a patriarch.
Right.
Not always, but that's usually the case. And that person may or may not have a good culture. They may
Mm-hmm.
be a great boss, they may not. And so that those business models can be really hard to staff long term
Yeah.
because the culture usually is fixed. And as an employee, even a senior one, you don't have a lot of input into the culture. Um, and you don't have you don't have a lot of career options that you would want to invest that time in trying to change that founder's mind and build a different culture.
Right.
And so that, we see it a lot in the market, a lot of single family office. There's a huge influx of new capital post crisis.
Yeah.
I think early on, and if I was a founder, I would probably be in the same spot. I would want the control. How do you get control? You build your own family office.
Right.
And you build it and you realize like this is a lot of work. Like this is as much work or more than it was running my company. And I really enjoyed that. That was like my dream. Like this is
Uh-huh.
not that much fun,
Uh-huh.
super expensive. My people keep leaving. And so what we see is we see a lot of single family office keep what they're really good at. And I think a good example is like real estate. If you made your money in
Mhm.
real estate,
Yeah.
you're going to do that much better than Alti or I'm going to do just by definition. And so a family like that, they might keep doing their thing and then start outsourcing reporting, technology, administration, family governance, the broader portfolio building of that more institutional investment portfolio to someone like this. So they might end up in a hybrid structure where they have two cultures to worry about. They have our
Mm-hmm.
culture, which hopefully melds well with them being client
Mm-hmm.
focused. And then they can continue with the culture they've had or the personality types that they've had forever.
Yeah. How about, you touched, quite a bit on family office and institutional, but how do you see family offices differentiating themselves from institutional investors in terms of risk appetite, time horizon, impact goals?
Yeah. So that last one's a big one.
Yeah, I
Impacts.
would think so.
We've talked a lot about purpose of wealth, and talked about a very high level. One important part of it is aligning your investments with your beliefs, whether those are social, political, whatever it may be. And so you see some of that in the endowment and foundation world, but it's complicated because you're investing for an institution with a changing board of governance structure. And so those values they're fleeting. Family values are fixed. Like
Mm-hmm.
families believe in things and they tend to stick. And so we do a lot of work, and I would say Alti is by and large a leader in this space in impact investing, aligning investment outcomes with people's view of the world. And we are flexible in that because it's not our values, it's the clients. But what we've found is not only does that build higher degrees of trust and help in some of these conversations we talked about earlier, but we spend a lot of time, and I personally do, working with G2, so that's second generation. So
Okay.
if it's an entrepreneur, their kids, working with the grandkids, if the family's further on, engaging everyone in the conversation about the family's wealth and I have found that impact investing is a great way to engage that younger generation. You often have a situation where mom and dad or one of them doesn't really care about it. The kids really care about it.
Mm-hmm.
And you can use that as a tool to bring them together and give them a common language to speak that isn't just like, I want to spend this amount, this is my money, this is yours. So
Mm-hmm.
it's not so territorial. It's really more at the human and family level. And that's something that I think is a huge opportunity in the multifamily office space. And both from just investment returns, but also from engagement and helping families to tease out that purpose of wealth and what they want their legacy to look like. And another differentiator, if you think about the institutional investing space, they are largely non-taxable investors. So they do not pay income tax.
Yes.
If they do, it's very low and it is not, it doesn't factor into decision making. So if you think about that world, if you want to fire investment B and hire investment A, you just do it. There's no friction costs associated with it.
Uh-huh.
In my world, that new investment has to not only beat out the taxes, but also beat out that old investment, which means like you can't change out investments as often as you would want to. So we spend a lot of time working with family CPAs, working with our teams to develop investment strategies that are as tax efficient as we can get them.
Yeah.
So that families have more to keep at the end of the year.
Yeah. But just being so deeply involved in, planning and educating heirs, what's the hardest conversation you have to have with the next generation, and how do you navigate that?
Yeah, I think the hardest ones are the first ones.
Okay.
And it really sometimes is less. I mean, with that second generation, sometimes it's a little bit of pumping the brakes. Like, there's a game to be played here. There are conversations that need to be had. They have to, they take their own time. You have no idea how long they're going to take. So, don't get too aggressive up front that you want to double your lifestyle and buy a new house. Like, let's ease into this. But the hard conversation is actually with the founder. Because again, back on this conversation of control, the more of a voice someone else has, in this case, your kids, the less you have. And so that can be the hardest transition, is working with that founder to give up a little bit of control, to come to terms with the fact that if you have say a 30-year-old kid, the die is cast. Like there's not a whole lot that financial incentives can do to change their behavior. Their behavior patterns are largely set. You can steer around the edges, but maybe getting rid of some of the stress around money, opening up kind of communication lines can more than offset that loss of control over these funds that, frankly, the founder worked pretty hard to earn.
Uh-huh. But I mean, it sounds like many of your clients also invest directly in founder-led businesses. What traits do you look for in a founder that suggests like long-term alignment with family capital?
Yep. So we don't do, as a firm, we don't do too much in what I would call direct deals, where we
Okay.
are investing client money directly into a company. And largely, it's just next to impossible for us to be experts in
Mm-hmm.
every industry, every geography. So what we'll do is we'll either outsource those decisions to like a venture capital manager.
Okay.
They could be a regional manager, they could be an industry specific manager that really knows that space. And so that's one option. And that all clients utilize, through their investment portfolio. So they get access to these founder-led businesses. And we are looking through those managers for realistic ideas, good glide paths, ability to raise capital to continue to grow these businesses. And then the clients themselves often have a specialty. It could be real estate, could be med device. And so what we'll do with them is it's hard for me to opine on, a startup med device company, and whether that technology is meaningful or not. I guess I can't do that. What I can do is look through the terms, look through the structure, and help a client understand, like, is there a runway here? Are these terms reasonable? Is it similar to what we're seeing when we invest across our client base? Or are there tweaks we'd make? And so we spend a lot of time with that. And sometimes, our families do a lot of investing on their own because, especially in the Twin Cities, this is a small community. There aren't a lot of investment managers, but they're all well connected with one another. And so our families often, want to invest in some funds that maybe aren't on our platform. And we'll work with them and with that manager to make sure that the terms make sense, that it is competitive with the industry, and it will help guide those managers too as they build their business. While we might not be investing at that stage, we usually have a lot that can help them reposition that fund or that structure to be more appetizing to the LT Tiedemans of the world.
Mm-hmm. How about in your teaching investments at Hamlin? Any particular lessons from the classroom that carry over into advising multi-generational families?
Yeah. So that class, that we take a unique approach, and Hamlin, it's a liberal arts school. For undergraduate students, it's the only exposure to investing they have.
Okay.
And so when you teach that class, you kind of have two options. You could take a very technical, quantitative approach, which would prepare someone if they're going to go into an investment program and an MBA, getting their MBA. I've taken a different approach because one of the things I've learned over my career is investing is as much or more about people and relationships as it is about math. Like, the math is important, but investing math is addition, subtraction, multiplication, division. There is not, maybe some exponents in there, but this is not rocket science for most investors. And so we really try to keep the kids at that higher level thinking, so that they can think through, what is the strategy trying to accomplish? So we'll talk about value versus growth. And then it's a Thursday night class, so we have to keep the kids awake and engaged. So I bring in a speaker almost every week to talk about their career, how important relationships are. So kids can start to piece together both what we talked about earlier, that careers are nonlinear. And so if your mind is closed to new opportunities, you won't see them when they come. And that people really matter. Like, your next career move, whether it's your first job out of college or your sixth, is almost guaranteed to come from a relationship.
Yes.
And so it can be very uncomfortable, and I'll have kids complain about it, but their first project in their minds has nothing to do with investing. It's a networking project.
Okay.
So step one, we go through LinkedIn profiles and I critique everyone in front of the class. I'd add this, I'd take this away. This doesn't make any sense. You've got nothing to sell here. Don't you have any hobbies or volunteer thing you could, spruce this up with? So step one, they do that. Step two, they have to pitch me, with a LinkedIn message, what's your elevator pitch? How are you going to get me to get my attention so I'll accept your connection and maybe you can take me out for a coffee or something?
Yeah, very good.
And then we do a formal networking exercise where I send them off into the wilderness. And they have to, on their own, without help, find 3 senior people in the industry that'll give them some time.
Very good.
And then they write about it. We get back together, and then I'll explain to them why it's investing, why that is literally an investor's job, why it's important. But in the beginning, I kind of let them just stumble through it. They're usually mad at me for a while because they're not talking to human beings in person.
Right.
They're not thrilled about buying someone coffee that they don't know and going downtown and trying to figure out parking. But the feedback once people go through the 5 stages of grief about it is usually pretty positive, because there's a light bulb moment where they're like, oh, this is why I'm not getting job offers. Just submitting applications and there's 300 other students applying to that same job, and there's no reason they're going to look at mine.
That's the truth. How do you translate complex investment concepts for families that might not have a finance background, but want to steward their wealth responsibly? And maybe that's looking at the next generation.
Yep. I think that is one of the most enjoyable parts of this job. Why I like it more than the very technical roles I had before. Because, in those prior lives, everyone speaks the same language. And you can have these conversations. You don't have to think about word choice as much. You don't have to think about kind of cadence to your conversations. And in this world, we have some very sophisticated investors, some that made their money as professional investors, and and parts of the markets know infinitely more than I'll ever know. And then we have others that we term widget makers, that they built a business that had nothing to do with finance, or at least like this investment management world. They may have been making cabinets or, nuts and bolts or something that they were very good at and obviously extremely successful. But the terminology in this industry just doesn't make sense to them. And so that takes, when you have a client like that, it takes longer to get to where you want. So you can't go into a meeting with a to-do list as an advisor and expect to get it all done right away, especially early in a relationship, because you have to find ways to talk about these topics that resonate with them. To do that, you got to learn more about them. You have to find kind of emotional strings to pull on that connect with whatever you're trying to achieve, so that they can make that connection and they can understand why it's important. And they may never fully understand what you're talking about. And we have one client that always jokes. He's like, I have no idea what you're talking about. If you ever want to learn how to build a cabinet, I can help you with that. But like, stop talking to me about it, make your decisions, and move on. And we have others that they want to know everything that's going on.
Yes.
But I think that's like the emotional intelligence of this job that I think you're always building is, that empathy, that ability to meet people where they're at, to understand what they're going to be able to understand. And then we have to be the chameleon. We have to change to reflect them and to be able to speak in a way that they understand it. And I think the even harder part is we like what we do. We want to talk about it. Some clients just don't want to. And it's not doing anyone good forcing that conversation. And for me, that has taken a long time for me to give up that feeling of control, of knowing like that client will not talk to me about this topic, but they'll let me do what needs to be done. And I need to just accept that as it is and then do my job.
Yeah.
And that's hard.
I believe that. I bet. Yeah. You're excited about it. And you want to like share this, but they don't really care. Just
it's
do
their
it.
specialty. It's like literally what I do for most of my day. And someone's saying, I don't care. That hits your ego a little bit. And,
Yes.
takes a little bit of an adjustment, but then you learn like, well, you get to talk about other stuff.
Yeah.
Which is fun. You get to talk about their grandkids and their kids. And, one of the real exciting parts of this career path is you slowly get pulled into the family. And so
yes,
a good percentage of my clients, they know my wife pretty well. Many of them know my kids. We have a lot that are very philanthropic and involved in the community, and we go to a lot of volunteer events. And so for me as a parent, that's been wonderful because not only do my kids get to see the world I'm in and start to get this feeling that I don't just like play with money, like I help people, like I'm working with people, but they get exposure to volunteering that they wouldn't have had without these families. And they get exposure to other groups of people that think volunteering is important, that think philanthropy is important, that think being involved in the community and not focusing only on yourself is important. And so as I get further along this journey, I find that I get as much out of my clients personally as they're probably getting through the services that they pay for.
No, that's amazing. How about, and I hear this mostly in the single family office space. In fact, I had one CFO of a family office. He's been the CFO of a couple single family offices over his career. And this was a recurring theme for him. And I'm wondering if this applies to multifamily office too. And it was building trust, especially with not necessarily the founder, but like the next generations. I mean, he talked about being the CFO for a large family office. He said, and it took about 5 years before the other family members really trusted me because they're so used to being so wealthy and people wanting from them and taking from them and trying to manipulate. And so they just don't trust anybody. And like he had been working with them, as the CFO in their family office for 5 years before they really trusted him and started to open up to him. Do you experience that in the multifamily
I'd say
space?
that 5 years is a pretty accurate number.
Okay.
Then, part of it is, and I won't throw anyone, specific under the bus, but this industry is not known for being, trustworthy and all the things like, you think about the wealth management industry, it has a reputation for people maximizing their personal livelihood at the expense of the clients. And that can be advisors, it can be firms, it can be business models, whatever it is. And so wealthy families, especially if they've been around the hoop for a while, they're used to it. Yeah, they're used to people having an ulterior motive. And that can be their wealth manager. That can be nonprofit organizations. Like you think once people know you're wealthy, everyone wants your money. It's not just the people selling a service, it's the people that need it to continue their mission.
Yes.
So in the Twin Cities, if you're wealthy, every startup company, every investment manager, they're all going to be talking to you because you probably have a golf membership at the same places that they hang out.
Uh-huh.
And you're just inundated 24/7 with people wanting your money. And
Yeah.
some of it's good, some of it's bad. But when you think about that that reluctance to build trust, like it's very easy to see where it comes from. And it's literally a function of time. And when we talked earlier about the investment puzzle ending up being a smaller portion than initially perceived, what I've found is when you start helping with these things that are closer to a family's heart, that
Yes.
trust builds much faster. And it can really snowball quite quickly when you take the time to learn about each family member and you start addressing their needs in a way that they can understand it. And then that can speed it up. But I would say 5 years is that's probably the average to where you feel like you're in.
Yeah.
Like you now do your job successfully because people will listen to you and they aren't questioning your motives. If you can get into that other stuff, even if it's administrative, like you go back to your question about the transition as a founder, and we talked a little bit more emotionally, but think about it just logistically. So you ran a business for 30 years, your dad might have started, who knows? But the line between the family business and the business of the family is so blurred. And you can take something simple like your home Excel energy bill. You may have no idea who's paying it, from what account, and where that bill goes. And what happens if you do a clean sale, so whether it's private equity, is strategic, or roll up, whatever it is, and all of a sudden on day zero, your controller no longer works for you. Your admin is no longer an employee. There is a lot that was getting done that new buyer is not going to do.
Uh-huh.
Some of that's just paying the bills, but the more important part is the logistics around it. Like, how do you get the stuff done?
Yes.
And so we found administratively, we can build a lot of trust because we have a team in here, family office services, and they will just take that all on and they will do proper accounting, and you'll probably see your expenses more clearly than you've ever seen them before.
I'm sure.
And something like that can speed it up. Or we have a family governance team or family governance and education where we'll sit down with people trained in this, far more, far higher skill set than I have, and really work through complex family dynamics to try to work out how the family can work together better. And you solve something like that, and that trust level, you can build it in a year. But if you focus just on investments, you're gonna be lucky if you build a high degree of trust with everyone in 5 years.
Yeah. Oh, very good. Maybe to your background. I mean, you've done a lot. I mean, Ameriprise, Malta, University Endowment, Emerging Markets Hedge Fund, now Global Wealth Platform. What role has been the most challenging in your thinking, and maybe why or how?
Yeah. I mean, there's probably some recency bias involved here, but
Yes.
probably my current role.
Mm-hmm.
And I think it's because people are involved. When you think about how you study economics, it's all about this economic man that is like some miracle worker that just makes all these rational choices.
Right.
And you model them, and then you can see what's going on. And then economics gets a bad rap because it's wrong more often than it's right. And it's probably because human beings are not rational. They don't,
Yes.
or that maybe not consistently rational. Sometimes we're rational, sometimes we aren't. And I think that makes this current role far more interesting because it's far more dynamic. Each person I sit down with is unique. They have a unique background, unique understanding, a unique level of care. Like they just might not care at all. Like oftentimes, wives of the founders just don't care.
Uh-huh.
They care when the inevitable happens, but up until that point, it's just not something that they need to worry about.
Yeah.
So that provides interesting conversations that I have to navigate through with even very different personalities within the same family structure.
Maybe along those lines, I mean, some spouses really want to know and just intricacies and how do I, if something happens, how do I get to this, this, and this? So how can you as a multifamily office help that founder, provide that information? But yet a lot of those things are constantly changing. And it's like,
Yeah.
I mean, it could almost be a full-time job keeping the spouse updated on how everything's moving and shifting. And so how do you navigate that other than, and I'm sure founders would like to say, if something happens, just reach out to Anthony.
That's exactly it.
But sometimes the spouse might not like that as the answer. Like, no, I really want to understand. So how do you kind of
Yeah,
navigate that? Because I can see that as a real thing.
it is. And I'll be honest, I don't like that answer.
Yeah.
Uh, we provide a very detailed reporting package. That part of that's just transparency in how we run our business that is available to everyone that should have access to it.
Mm-hmm.
So we first step is we make sure both husband and wife have access to the same information should they choose to look at it.
Uh-huh.
The truth is someone usually takes the lead.
Right.
Um, and we try our hardest. This is probably something I'm not good at yet. Maybe someday I'll find a magic bullet, but we try our hardest to get everyone involved. But you can't force it.
Right.
And fortunately, I had two patriarchs pass away last year that ran the show. Both were CFOs, so you can just imagine that personality type.
Okay. Yes.
And then all of a sudden, the wives in the family got the instructions call Alta, which they did. But you could come to find out, like, they're just not ready for it. And they're going through a level of grief that they're not prepared for. And then all of a sudden you've got this. And frankly, a lot of families start going into the end with far more complexity than they need. They don't start cleaning house early enough.
Yeah.
And it's something I wish I could beat into the heads of all like the 55-year-olds out there that although they want to be active, now is the time to start slowing down.
Uh-huh.
Because your family pays the price for the complexity. So if you're doing a bunch of stuff that we can only advise on, but we can't take discretion on, we don't have as much control over how you executed the deals, how they're being tracked, if we can get out of them, if they're, being, well reflected in your estate plan. And so even for these CFOs, which were more buttoned up guys, just because CFOs have a personality type,
right,
there was a lot of work. And then, it's our role to help shield the family from that work, but you still need signatures, you still need decisions made. And it can be really, really tough. And so that's a non-answer to your question because I don't know how to solve it.
Yeah.
Besides engagement, I think, leaning on impact can be a way to maybe get the rest of the family engaged earlier. So if they don't want to talk about just how do we make more money, if they want to talk about doing good, through their value system with that money in ways that's not traditional philanthropy, at least we can get them into the room.
Yeah.
And I do a lot, especially with families that are local. I just go to the house. So a lot of times the patriarch, the founder wants to come in. They like the feeling. They like to kick the tires, see the team.
Yeah.
Well, we'll go out to lunch. We'll make a half day of it or something. But a lot of times the kids feel uncomfortable coming in here, and I don't blame them. It's weird.
Uh-huh. Yeah.
They view it as dad's people, usually early on. The wives don't want to come in here. And so that's one thing we do, and we can probably even do better, is just meet them where they're at. And if they don't want to come into a formal office setting and they don't want to see me in a sport coat, I can put on a polo shirt and some tennies.
Yeah.
Over to the house, and we can have coffee. And, kind of back on things I've learned, we historically were very heavy on like pitch books. So if we sat down with you as a client, we would have it all buttoned up, and there's a good reason for it. But what I learned there's certain personality types is that kind of scares them away. It feels like homework. It feels too formal. And so some I've started coming with some notes jotted down on a sheet of paper that they don't even need to see. We can have coffee, and we can talk about grandkids, and we can just tease out these decisions in a way that's not stressful.
Yeah.
And doesn't put any pressure on someone to have to be in a situation that they don't enjoy.
Yeah.
Things like that, probably we can get more of the spouses involved if we meet them where they're at, and we do a better job understanding what would be helpful.
Yeah. I can tell just by your tone and listening to you. I mean, you're just like perfectly wired for this work, just being super empathetic and understanding and curious. And
You should tell my wife that.
yeah.
She thinks I'm the most high-strung human being on the planet. But I do think in
Yeah.
these
Yeah.
situations where I'm seeing someone's life from the outside in,
Yes.
it is easier to
Yeah.
stay
Oh, for sure.
non-judgmental and to really empathize with where they're coming from, and just view it as like we're providing solutions. Like if
Mm.
you have an issue, let's just solve it. Let's not judge it. Let's not
Yeah.
think too hard about it. Let's just get you to a happier place.
Yeah.
And we'll all be good.
Yeah. How about what's like one mistake you see ultra wealthy families make repeatedly? And what advice would you give to avoid that?
We can think of two. I'll give one from investing, one from spend. People buy too many houses. So if we see anyone that goes from being a client to not, chances are they overdid it buying too many homes. Because
Okay.
homes are expensive. If you're going to build one, whatever your budget is, you might as well just double it by the time you're done, especially when
Right.
you're dealing with these big, massive homes.
Yeah.
They're expensive to maintain. They're stressful. They're all these things. And everyone ends up with too many because as a founder, you end up with a bunch of pent up demand. And that first 5 years is really dangerous. Spend a lot of money on stuff that you think you want.
Uh-huh.
And so I would advise this to anyone of any income level. Like tap the brakes on your decision making, especially spending around big life events.
Mm.
So whether it's a death, a birth, a marriage, a divorce, sale of your business, if it's a big life event with strong emotions tied to it, just pump the brakes, wait a year, because those are the periods where people make the most financial mistakes.
Okay.
And that's true whether it's, people without a retirement account to think of, or someone worth $300 million. It's human behavior. It happens every time. And so that's kind of on the spend, and you could probably lump into there like airplanes and boats. Like those are also great ways to not build net worth and watch it just like go down the drain. But real estate's a dangerous one.
Uh-huh.
And then on the investment side, and we already kind of touch on it, it's like people want to do too much. They have a hard time understanding that investing is largely a passive activity. And successful investing comes from looking at a lot of deals and saying no to most of them.
Mm.
And if you're new to wealth, new to liquid wealth, everyone in town is going to be calling you for money. And it's really awkward to say no. And I think that's where, having a proper family office structure, whether it's single, multi, or a blend, and not necessarily just a traditional wealth management structure is important, because then I can say no.
Mm. Yes.
Or I can make them like sweeten their terms, or I can say, yeah, Kip can do this, but he's not giving you $500,000. He'll give you 50. And that can, buy some breathing room for clients to maintain relationships throughout the community. Because again, this is a very small community.
Right.
Everyone hangs out the same places that has wealth. So you can keep those relationships. You can feel like you're supporting.
Yeah.
But someone else can be the bad guy, which I'm
That's
happy
very
to play
good.
with.
How about if you could redesign the relationship between family offices and founders, what would you change first to unlock more value for both sides?
Yeah. Two things. Number one, get the whole family involved sooner. Build a governance structure. Start becoming more transparent earlier. It just saves a lot of headache, and you can maybe avoid some of the resentment and behavioral issues that come from kids that come from wealth that have a feeling of zero control over their destiny. So I think that's one, just like talk as a family together about financial things, which none of us are good at. My wife and I probably don't talk about it well, and I do this for a job.
Right.
Then the other one, and this is the harder one, is entrepreneurs need to put this structure in place earlier. They do it when they sell the business. They think they have the right team in place. They feel like they can't afford it at the time, but it costs them a lot of money. It costs them like explicitly, and that they probably aren't tax optimized, and maybe they might have a CPA that's okay, but probably should have been upgraded, or they have an estate plan that's reasonable but not great. So that's one. And then you think about the longer term, the sooner someone like Alti is at the table, the quicker you can start that 5-year process of building trust.
Yeah.
Like ideally, you would have the trust when you pull the trigger on selling the company, when all the big decisions have to be made. But what happens is most people push it off until they sell the company, which means the valuation's already set. A lot of the
Yes.
estate planning maybe was done, but might not have been. A lot of the big bang for your buck is gone because the government knows what you sold it for, and you have a very clear mark, and that's what you have to gift shares at. And we all only have a certain amount to give without estate taxes, and we want to be as efficient as possible with that.
Oh, very good. All right, last question.
Okay.
This one's for you. Success. What's your personal definition of success for yourself? And you can take that any direction
Yeah.
you'd like.
I think for me, it has changed. Like every decade, how I've defined success has been very different. I'm very goal oriented, so I set goals. And you think back to like my origin story, I just wanted financial security.
Yes.
And so my wife and my wife's a public school teacher. We live what I think is a pretty, reasonable lifestyle.
Uh-huh.
We paid all of our loans off early. We don't have car loans. We don't have a house loan. But then, after that, I realized like I kind of hit financial security unless I changed my lifestyle significantly.
Mm-hmm.
And then for a while there, it was like chasing titles and that kind of stuff, which became fleeting and not that interesting. And at this point, for me, success is having control over how I spend my time. And that's not so much like a dichotomy of like, I only want to work this much and not work this much. It's about, it's weird. It's like you want work-life balance. I actually want them closer together. Like I
Mm.
want the lines between my work and my life not to be so distinct so that I don't feel like I'm working when I'm working and feel like
Yeah.
I'm, you know, and part of that's because I get to hang out with my clients. I enjoy time with them. And so spending a weekend at a gala with a family is not work because it's fun. My wife and I get to go out and
Right.
hang out with friends. And so that's been a weird thing to kind of come to terms with, that I've fought for a long time of really separating those two. And now I want them closer together, but then I want to be able to leave at noon for my, kids' band recital
Uh-huh.
and not feel any negative emotions around that and not
Yeah.
feel like, the team's like, where'd Anthony go again? Because
Mm-hmm.
everyone knows and I know that it's just a little bit more fluid. My life is, everything's just touching, and that's okay.
Yeah. Oh, that's fantastic. Well, Anthony, thank you so much. This has been fantastic and great insight into you, your journey, Alti, the world of multifamily office. So yeah, thank you so much. Really appreciate this.
Well, thanks for the time, Kip. I really enjoyed it.
No, absolutely. And we'll share in the notes, how people can get a hold of you, learn more about Alti, learn about
Perfect.
all that's going on. But again, this has been fascinating and really appreciate it.
Wonderful. I appreciate your time.
Oh, for sure. Thank you.
Yep. Thanks.